and I hope everybody enjoys this. So welcome again, welcome Jure, it's great to have you here.
Thank you.
Thank you for having the time to come here and talk to us about venture capital and your entrepreneurial journey so far.
Okay.
So yes, can everyone please just turn off, including me, turn off their cell phones? That's always a good idea.
I think mine is
It's too far.
it's too far, yeah. It's dead already, probably. So.
Okay. So
Where shall we start?
from the beginning.
Okay.
You were born in.
I was born a long time ago. Well, that's a long time ago, some 40 years ago. In Ljubljana, I'm from Slovenia. Born, raised, everything in Slovenia and here in the region. Maybe just that would be a good idea. Thank you. Maybe just to give you some insight in my background, how I started after the. Well, not after, but during the studies on the Faculty of Economics of Ljubljana, I kind of decided to become a stockbroker. So I started to read all the books and newspapers, and at that point there were not so many web portals about stock exchange, about stocks, equities, bonds, everything else. I even competed on some of the student competitions for stock trading, making some returns and a lot of losses as well. And then at some point I think it was in 98, I applied for the internship in a local commercial bank on the investment banking department. And they took me in. I mean, it was like I just sent one application, and they just called me and said that, yeah, we'll need some help this summer. Can you join us for a couple of weeks? I went there, and after a couple of weeks, they asked me to stay another couple of weeks. And then after a month, a colleague of mine just quit his job there, so they asked me whether I would stay for a little bit longer, which resulted as the extra 2 years of my studies, where my parents were not so happy about that, because I was studying and working at the same time, of course. I was analyzing mainly stocks on the Ljubljana Stock Exchange and some of the stock exchanges here in the area. Then moved to one of the brokerage houses, became a stockbroker, traded stocks again. It's a lot of stocks, right? In 2002, I think, I became the portfolio manager of the mutual funds for the KD Group, which was, we also had one fund here in Zagreb. It was called KD Victoria. And just to bring this stock story to the end, in 2006 I somehow decided to move out of this financial stock exchange world. The reason for that was that I was kind of fed up with trading. It sounds very interesting when you see on TV or when you read some Bloomberg news and stuff like that. But in reality, you just more or less move the money from one pocket to the another, or from one bank account to the another. It's not, you go to some conferences, you go to some meetings, shareholders meetings, you analyze the companies, you talk to founders, CEOs, CFOs, mostly CFOs. But it's not that you would create any real added value in that industry. So I somehow decided to begin something new. There was none VC fund registered in Slovenia at that point. The whole entrepreneurship was not as developed as it is today neither. Although I somehow thought that there has to be space for one VC fund in a country like Slovenia.
At least one per country.
At least one per country. So I went to the Chamber of Commerce, and my pitch was so terrible that I'm ashamed today just to repeat one sentence out of that. But basically, the whole idea from my side was, look, we've got this whole economy that is based on some traditional industries. Like 10% of Slovenian GDP comes from automotive industry, and these are all second-tier suppliers to the German automotive industry, which means that we are, most of the people, or 10% of the people, work there for very slim margins, which is not very competitive in the long run. So I've told to those guys there, let's make something new. Let's make some, let's make a fund, and let's help those startups, on their journeys. Basically, the only example that they understood was Skype at that point. So this was, there was no, I don't know, Facebook or Google or Outfit 7 to be shown there. This was really hard to convince them. Even the financial aspect of the investing in a VC fund was not on the in my pitch. I mean, it was, but I was not competitive, because at that point the funny thing was that the stock exchange was doing like 30-40% per year. The Slovenian stock index was doing like 25-30% per year. And when they asked me about the returns on this VC fund, I was super bullish, and I said 30, which is, of course, we will not achieve, right? It's way too much. But they got back to me and they said, no, that we can do 50 on the stock exchange, and the real estate we can do 60. So why would we invest in a fund if we can do just 25? Most of those guys who were telling me this are dead today. I mean, not literally dead. Their companies at least are dead. So I got at that point we raised funds from the Chamber of Commerce. Then we raised some funds from I think 6 corporate investors that bought. They all bought this story about bringing new talent, new technologies, which in a way was the most realistic one. So altogether was 10 million euros at that point. This was in 2008, and then Republic of Slovenia decided to participate in European. In one, it's called the European Venture Platform. They could raise some structural funds from the European funds, and they combined this money with some budget money. So they invested 9 more million euros. So altogether 19, out of which we've invested pretty much all of it. It was 16 and a half, I think. 11 investments, all tech investments. One of them already dead. 2 of the existing portfolio are, let's call them, in the ER room, meaning that they would not survive without any, bloodline from our side. But on the other hand, we've got a couple of champions, and just to give you one example, a company that we invested in 2009 was pre-revenue at that point, just 3 founders, and today we've got 160 people in. Let me see how many offices we've got: San Fran, London, New York, Ljubljana, Tokyo, Sydney. six, seven offices, and in revenue-wise, we're around 35 million in dollars. So we need a couple of companies like this.
So that was RSG Capital, right?
That was yeah. The fund was called RSG Capital, and don't ask me about translating this because it's even nonsense in Slovenian, not just. So yeah, in 2013 we decided to go for the next fund. You know, the next fund. We started our fundraising activities at that point, and we came in contact with the representatives of EIF, European Investment Fund, which is the European Investment Bank, the bank of the European Commission. And they've told us that there's a tender going to be published. I mean, it was a public tender for the fund manager of an investment facility for the Western Balkans. We gathered a couple more guys on board, changed the name, and then went for this public fundraising. At the same point, we went for private fundraising. We at the end we raised. I mean, we did two closings, one in 2015. Yeah. At September 2015 was the first one on 26 million euros, and then in April last year, I think it was the second one on 40 million euros.
Cool.
So the fund is called, I mean, the whole structure is called South Central Ventures. It has nothing to do with LA. And the fund is called ENIF, which is out of the European Innovation something.
Network, probably.
It's the EIF. Yeah, it's a program from EIF that has 4 pillars. I don't know how much do we have to talk about this, but there's one component for the technical assistance. Then is this ENIF, and it's ENIF, which is a later stage fund managed by EBRD, and then it's also the bank guarantee scheme, which is also managed by the EBRD, I think.
Was it easier to set up than the first one? And now you have examples of startups to invest in.
Well, in terms of the fundraising effort, it was definitely easier to raise the first fund, even though it was much smaller. But it was definitely much easier to raise it. It took us like less than a year to raise the first fund, and it was much cheaper because we didn't use the international consultants and lawyers that you have to use when you're dealing with investors like EIF, EBRD, KfW, and similar. So it was that was a peanuts compared to the ENIF fund. Which took us like 2 years to raise. I will not disclose the number that we paid to the lawyers because it was so ridiculously high.
So how does one go about on creating a venture fund? So you described the first and the second one. Other than fundraising, what are some of the key components you have to do to make it all?
Well, you can see a lot of guys running around and saying that they're just about to raise a VC fund. You know, this is if you go to some conferences here, you always meet a lot of guys who are just giving business cards and they're just about to raise the VC fund. It's a chicken and egg situation always, because in order to raise a fund, you have to show the pipeline. So all the investors, I'm not telling about some investors that just came out of some real estate business or stock exchange or I don't know, car dealers who have generally not not a good idea, and not a lot of experience with investing in VC funds. But if you talk to experienced VC investors, we call them LPs, limited partners. Then the first thing they ask you is who you are and what's your pipeline, and you have to show that to them that you have the you see the potential in your market and you have the ability to deploy these funds. So you need pipeline. But if you want to have pipeline and you talk to the startups or I mean the target companies, you need to show them that you have the fund, because otherwise nobody wants to talk to you. So it's very, very, very difficult to to be in a position where you're still raising a fund and you're promising something. It's you have to be convinced that you'll be able to raise a fund. Otherwise, you're just
Same like the startups, fake it to make it.
I want to use the word BS, but it's basically the same thing.
So you mentioned the pipeline. Can you tell me a little bit more about that? So
About our existing, no.
No, but just an example. What is it?
Well, less than 1% of all the companies that we see get our investments.
Okay.
So if we see 200 companies, we do like 1 to 2 investments.
Okay,
That's
so
the stats.
Pipeline of startups for you to see to invest in.
Yeah.
Okay.
Yeah. So and that's a numbers play. I mean, you can be very selective and you can just talk to a smaller number of companies, but normally you talk to a lot of companies. Out of them, then you'll just come down to this small percentage that you'll actually invest at the end. And it's not just we can talk about what are the key the key characteristics of the company that we're looking for, but even if you like the whole idea and even if you like the company, that still doesn't mean that you'll invest. There are a number of reasons why maybe you will not invest at the end. And if we already started with this, I can tell you that the number one is always, and I mean it always, is the team. That's I mean, even if somebody has a great idea, if we don't see him as as a person who I would like to work with on a weekly basis, we will not invest. That's rule number one. And it can be very personal. It can, there are no strict rules regarding this, and it doesn't mean that if somebody is rejected by one fund, cannot talk to the other, and get the funding there. But it really is that if you cannot talk and feel the person on the other side as as a person who you could work with on a weekly basis, you would not invest. I mean, at least I will not invest.
So what are some other things to
then we
disqualify a startup?
Well, there's a long list of the wrong answers to the VC's questions. This is, as you can get on Google. There's a long list of those. For instance, if you there's a thing called pitch, right? Okay. Which is not a wrong thing. Everything starts with a pitch. Sometimes it's more structured, sometimes it's less structured. It can be a pitch can be a normal coffee somewhere in some cafe. It can be a bus ride. It can be elevator pitch. This one is very popular, even though it never happens in the elevator. Then it can. I mean, it can be a referral from a common friend. Just can you have one Skype call with somebody that I know and I trust him and so on. So everything starts with a pitch, and there's there's a couple of things that every startup has to know before he or she, starts with this pitch. Number one, what is, know your numbers. This is the major rule. If I, as a VC manager, know more about some industry than the startup that is pitching his idea to me, that probably is not going to work. When I ask somebody about a competition, it's not, definitely the right answer is not, there is no competition. So that's another of those simple but stupid answers that are not right. What else? You have to know what the market size for your product is. You have to know what's your business model. How are you going to make money? You have to be realistic about the needs for the funds. I mean, how much will this cost me to develop and to sell? You have to know. You have to present the whole team, not just yourself. Because if you're a one-man band, we'll probably not invest in you, because if you get hit by a car outside, we have no life insurance on you. And so on. I mean, there's a number of things that you have to know in advance to be to increase your chances on the first pitch. But what I wanted to say at the beginning was that that this pitch is not. It is super important, but it's even more important is to build this relationship with the VC fund managers. Not just that you approach somebody at the end of a conference or a meeting or whatever. It's much more appropriate to to be introduced by somebody, and then just give the updates slowly, not like over a year or over a couple of months, because we've never invested in a company just based on one pitch or after a couple of discussions. It was always that we met the founder and then met him again and again and again. He was just coming back to us with some updates, and after a year you can it's much easier for us to invest in somebody because we know him much better.
Yeah, you have established a relationship with them.
Mm-hmm.
So you mentioned something that was really interesting for me. In RSG, I think you invested in a startup that was pre-revenue.
Yes, pretty much all of them. Yeah.
Really? So usually, we seriously wait for the company to be at least profitable.
No. Profitable companies. I mean, it depends, of course, on each specific case, but normally VC, targets in these stages where we invest, meaning from seed to so-called late seed stage, we invest we invest from 100K to we can do even 3 million per investment. Not, of course, on one ticket, but in a couple of tranches. Normally, the companies would not be profitable at this point, because even if they are profitable today, because they're bootstrapping and they're spending as much as they earn, immediately after our investment, they will they'll not be profitable anymore because they'll spend more. They'll spend our money as well. So it's good to see some revenue. It's good to see some traction. It's good to see some clients, but it's not so crucial. On the other hand, if you just have an idea or a business plan, that's not enough neither. I mean,
Is it enough if you are a serial entrepreneur or have had successes with startups before?
Yeah, that helps a lot, of course. Yeah.
Then you can maybe go with an idea. But still,
we've got a couple of founders from our first fund, which I'm pretty sure that if they come back to us with their next idea, we will, write checks just based on their business plans, or not even business plans.
Because you already know them.
Yeah.
So, what are some of the things you are looking at with the early startups versus some of the things you are looking at now with the SCV? So is it the same things, or did you change something?
Yeah, we became older. Maybe more conservative, I must say that. We've learned some lessons that we had to learn, obviously, but the focus of the fund is pretty much the same, meaning that we are still looking at the same type of technologies. We're not investing in some, for instance, nanomaterials or life science companies, because these type of companies have very high capital demands. Every life science company has, these R&D cycles which are extremely long.
Yeah.
The fund itself is a normal VC structure that lasts for 10 years, and then we can extend it for 2 years. So this automatically means that we cannot invest in some biotech companies, for instance, because the whole R&D cycles there are too long. Apart from that, we are leveraging the knowledge that we have in our existing portfolio companies from first and from the second fund.
Mm-hmm.
Meaning that if somebody wants to get some insight in some specific industry, or when we do the due diligence of a target, a company that we might invest in, we can use the talent and people from the existing portfolio, and we know that we can trust them. So it's much easier in a way today as it was like 5 or 10 years ago, when we did not have such people in our network. But in terms of the the size of the investments and the industries, I think it's very similar now as it was. Maybe the biggest difference is that the markets are much more developed than they were like 10 years ago. This is probably the biggest difference, especially when we especially when we talk about Croatia, Serbia. The whole ecosystem is much more developed today.
So is there something you look for particularly that you haven't before? For example, yes, of course, you look at team. That's the most important thing, to establish a relationship with the startup and see how they do. Will they fail? Will they not? But is there anything else you've added to from your experience with the first batch, do I say, cohort? What is the term for them?
Well, it's from the first fund, yeah. No, as I said, we learn constantly. Every investment has a steep learning curve, also for the partner in the fund who is managing this company, And being from, in those 11 years since we started the first fund, I can say that I've met some of the best people in my life. On the other hand, I've met some of the people that I wish I've never met, because it's not, it's. I know this is something that you'll hear on every startup conference and read in every startup book, but a VC or angel investment is truly like a marriage, and it all starts with a date. So the first time you see the guy or the girl, it's all, and the first pitch that you listen to, it's always, everything is so nice and everything is so promising, and it's going to be tons of money, and and we are going to change the world and so on. And I call this period a honeymoon, which lasts around a year, maybe a year and a half, until the funds go up. Meaning, as long as the company lives out of our funding, they're all nice. All the founders are nice. The meetings, board meetings are sometimes even in some locations that are not very cheap. You know, you can see that, you know, there's money, we can spend it now. But after a year or a year and a half, once the, you know, the funds get, you know, they're getting, you know, or starting to they're starting to run out those funds, then you can see the real, you know, character of the company, the real DNA of the company, and the founders as well. The founders become much more nervous, of course. They don't listen to you as much as they were listening to you while, you know, you were just giving the funds. And it's truly in some cases it was a big shift in the whole dynamics, you know, between us and the founders. And we would like to avoid that, you know, to invest in the wrong type of personalities in a way that even during this due diligence process, which takes, I mean, from the first meet to the investment, it takes more than half a year. During this time, we normally try to put them in some, you know, situations where they are under stress, you know, and they so that we can see what their natural behavior is.
So you're doing stress testing on them?
We're doing stress testing, including having a couple of beers, maybe. Because having a couple of beers, maybe 2 or 3 too much, really brings out some specific behavior by some people, yeah, which might not be very welcome to have in your portfolio. So you can really see what type of, you know, personality is once he or she has, you know, 2 or 3 beers too much.
Speaking of, what are some of the dangers you want to avoid when with the people you already started the relationship with? What are some of the things that are even worse than the company not staying alive?
Well, this is very connected.
Well,
so,
as a
so
VC, what are you afraid of?
we're mostly afraid of I must say, bad founders. You know, again, I'll just repeat this. I mean, I know that I've said it before, but if you have a good team, a good founder and co-founder, and they don't have the, you know, they don't have a product which will become a success today, they'll probably not find some pivot or a new way how to sell this technology or how to develop a different type of technology, and find the right product market fit for the, you know, the new one. But if you have a poor team,
yeah,
they can have a space shuttle today, but they cannot activate it. It's not going to work. Even if it works today, you know, it's not just that companies fail because of their poor products or you know, the products that are not that don't have the product market fit. Sometimes companies fail also because they become so successful. You know, success comes instantly. You know, and they don't know the reasons why they became so successful. You know, in such a short time, and they don't know how to behave in that situation, and probably they'll do a couple of bad moves, and they'll they'll go bust. I've seen that many times. So also the success can be a very uh, it can be a stressful situation for the founders if they become too successful and they cannot handle this. It's like celebrities. um, some of the founders are then starting to visit all the startup conferences and just they just talk about how they became successful. They don't work on a daily basis with their teams, and probably the whole culture in the company will change, and this will maybe, it's not that it will for sure, but maybe it will drive the company down.
So the faster they grow, the culture wasn't able to keep up.
Yeah, that's a very important thing, because the company, when we invest in a company, the company has, I don't know, let's say 5 to 10 members,
Okay.
maybe 15. The founders are probably the profile of the founders is probably some, technology. Maybe some of them are none of them is experienced businessmen. This is the first thing. You've got some salespeople, you've got product people, you've got what else? Scientists. Also, these are also product people. And they have, let's say, 10 people in their team, and they can manage this. They can go to lunch together, all 10 of them, and then they become successful. They start selling. They first have to hire salesman, right? A good salesman, business developer. Once they hire a good business developer, it's very probably this business developer will become a kind of dominant, figure in the team, because this is how how they behave. If you're a good salesman, you can sell yourself as well. So and this will, for sure, this will have an impact on the DNA of the company, on the culture in the company. And then as the team grows, the founders will deal less and less with the basics, like the product. Even if they are at the beginning, even if they sell the product, they will sell it less and less, because they will have to focus on people, managing the team, and they'll become managers. And this is the major transformation which most of the entrepreneurs are not good at, because they cannot be, if you're a good entrepreneur, most probably you're not a good manager. That's a big difference. And once you have a team that's growing so rapidly, you hire people from startups, you hire people from corporations, from some public agencies. These people are bringing, their own, views and culture, and it's impossible to keep the same startup culture in a team that has 200 people.
Yeah.
So, and the whole, even, I don't know, it's a long story, but even if you think of the salaries, if you have a startup and you have, I don't know, 10 people around yourself, and you just go out and say, look, let's do this, let's make this deal, and if we do this deal, I'll give you, 10% of the revenue from this deal to everyone, because everyone was involved in this, and you have this, this team spirit and everything else. But once you have all the support services, all the the accounting services, all the people that are not so directly related to the business development, it's very hard to set up all the bonuses and everything else. So it's extremely hard to retain this startup culture in a company that has that's grown very rapidly and has significant number of people.
So some of the startups you invested in, do they open a company in Slovenia, or were they elsewhere?
Um, I mean, from the purely technical perspective, we need to invest, we need to deploy all the funds in the target geographies here in the region. So they all have to have companies here in those geographies here. But we've had companies that had, let's say, one company here, and then a parent company in US or UK, because sometimes it's easier to sell your product if you're a UK-based company as opposed to,
Yeah, or a US-based company.
or a US-based company. If you raise the next round from some US investors or from some UK investors, you'll 90% probably open a parent company there, because they will not invest in a local company here.
Speaking of investment, of course it depends from one startup to another, but up to how much percentage do you take when you invest in a startup?
Yeah, that's very very important as well. We always look for investments that are below 50%. Due to some regulatory I mean, all know what the legislation here in Croatia, Slovenia is. So if you want to have a normal control in the company, if you want to control the major strategic decisions, you have to be above 25%. We even would invest in less than that, but then we have a separate, agreement where we set the voting rights in a different way. But for this stage of the investment is, for this later seed stage, it is normal to have somewhere around 20 to 40% of the company. We have also, we always invest as a mix of equity plus some convertible notes. It's much easier to negotiate the valuations if you have this so-called floating valuation, meaning that portion of the money that goes through the convertible note can be converted into equity based on some results, and these results are agreed with the company before we invest. So if they say that they will make 2 million euros in revenues next year, then we say, okay, if you make 2 million, we'll get for that portion of money, we'll get extra 5%. If you make less, then we'll get more, and vice versa.
So incentivizing them to succeed, basically.
Yeah.
Can you take us through an example of investment in a startup? So you met someone, you talked to them, that they have a good team, product seems good or being developed nicely. So how does it happen?
Yeah, it's a pretty long procedure, which takes us more than 6 months normally. First, we do the so-called desktop research, meaning that our analysts they perform the whole research on the markets, competition, team, product, even some insight into technology as well. What's the business potential of this product and so on. And this is performed through a number of meetings, analyzing the materials that they send to us. We even have access to some of the, I'll call them, most expensive databases on the planet. And this is the first stage. And at this point, we decide whether to go, to take the next step or not. Then the whole project comes to the. There are a couple of documents in this stage, but this is just these are details I won't bother you with at this point. If we are happy with what we see in this stage, then we go towards a document that's called a term sheet. And the term sheet is a shortened version of the investment agreement. Let's put it this way. It's a document where the major terms are described and defined. So in this document you could find everything about it, the corporate governance, everything about the valuation, the amount of funds, the purpose of the investment, a number of things. And this document is then shared with the founders, exchanged some 20, 30 times, I don't know, it depends. And once we agree on the terms, then this document can be signed, and this serves as a platform as a basis for the investment agreement. After the term sheet is signed, we have the so-called investment committee meeting, where 4 partners of the fund sit down and discuss, and if all of the partners agree with the investment, then we go further. If not, then the investment can be or completely rejected or sent back to the to our team to investigate further, or to renegotiate some of the terms and so on. So if we decide to invest, then we begin with the due diligence process, which has roughly 3 parts. One is tax, the tax and legal, meaning that we engage some lawyers. Then we have product, and we engage some industry specialists who knows enough about this technology to to take a deeper look at the code, the infrastructure, the architecture, and everything else. And the third part is more, I would say, bureaucratic, because it's also the result of having big European institutions in our fund, because we have to take care of the compliance regarding some integrity checks and stuff like that. So once we have the whole due diligence process finalized, then we can start with the investment agreement, which again is performed by some external lawyers. And after we sign the investment agreement, we can deploy the funds.
So other than the funds itself, what are some of the values you bring to the startups?
Well, all the investments that we have, in all the investments that we have, we also have a board member. We always have somebody from our team to be like a board member in the companies. We do not interfere the daily business of the companies, but we raise our hand when we see something that it's not within the strategy as we understand, and we co-sign all the the major costs, meaning that we have the access to the bank account, but the company can do with the money whatever not whatever, but what was pre-agreed with us. But if there's a number that has to be that exceeds the certain threshold, then this needs to be co-signed by us as well.
Sure.
Yeah, sure.
Is that kind of
Questions are later. You missed that part, sorry.
I'll remember the question.
Plus, of course, we meet with the founders on I would say on a weekly basis. Sometimes we just have some briefings on a weekly basis, but on a monthly basis we've got longer meetings, and we discuss pretty much every major issue that they have. So we, as I explained earlier, we have this portfolio of two portfolios now. And I'm almost sure that for every challenge or issue that comes up in a certain company, we can find the right person who had this similar issue. somewhere in the.
So you have
In the
more
night.
experience now,
Yeah.
even with the partners and with the previous founders of startups
yeah,
in the
exactly,
portfolio
yeah.
to solve most of the things that come up with the new batch. Can I call it?
Yeah, new fund. Yeah, we
New
don't
fund.
have badges. Yeah.
Okay. So what do you call startup? Investee or just?
They're investees. Yeah.
Okay. So can you tell me what are some of the things? How will you subscribe? Not ideal, but based on all the experience you had up to now, a good or great startup team. What constitutes it?
Yeah, it's as I said, this is the most difficult part and the most important part, because all the teams have to have team members that are specialists on their own
Market?
not just market but their own fields. Like you have one marketing guy, you have one product guy, you have one who is in charge of the finance and so on. They have to to be able to work with each other, but at the same time they have to be, it's not good to have everyone blowing in the same direction. This is they say that in Silicon Valley it's not a problem that they all smoke weed. It's a problem that they all smoke from the same pot. So it's sometimes, if you don't have this different views on a certain topic, it's very dangerous to go into the wrong direction. So they have to be interdisciplinary, but at the same time they have to have this common goal where they go. So this is the most challenging thing, and how to keep them together through all the stages that were described earlier. Because as I said, once they make the first, I would say, once they make the first million, or when they see that they will make the first million, the interests become not so aligned anymore. It's and you have to know that most of the startup guys are that we talk to are, let's say, in the ages from 25 to 35, and these are also the people that are, I don't know, creating families, and they're moving from one place to another. It's a lot of changing in the lifestyles as well involved, and this all is reflecting on the team dynamics. So it's very, very important how to nurture this culture and the relationships between them.
Okay, cool. Well, I can definitely talk to you with at least an hour or two more, but I'm going to open the floor to questions from the audience now. Okay, now go.
Sure. About there being a threshold that the board member from the VC fund has to co-sign, I didn't hear that term. Is that also part of a term sheet? Is that defined in the term sheet, or?
Yes, it is. Yeah.
Okay.
Normally, I mean, it depends on the size of the investment, or the size of the company, or the industry. But I think in 80% of all our investments, this threshold is set at 10 to 20 million, 20K, not 20 million.
20,000 euros.
10 to 20,000 euros. That's the threshold.
Already like red flag.
Look, I'm always telling them that because we are always having questions. Is this necessary? Because we are signing contracts on a daily basis. But this doesn't mean that somebody cannot sign a contract, which will get today, and he needs to sign it today. Normally, in a startup world, you don't sign transactions for 20K on a daily basis without knowing for them,
Yeah.
So I just tell them that it's one email that's sufficient for me. Just send me an email and put it, like tomorrow I need to sign this contract for 20K. and maybe attach the draft contract, and I'll just reply to you in a day with yes or no, and that's it. No, so it doesn't slow down the whole dynamics of the company.
Got it. Okay. Second question about the part before the funding, actually before the negotiation about the term sheet, about your like preview phase where you meet the founders and stuff. It's hard to say universally because every company is different in terms of metrics, but are there like certain metrics that you try to track for this 6-month period, or do you track milestones if the startup is gonna? Maybe a couple of examples.
Yeah, it's
what you took into.
No, it's a very good question. Thank you. Because what normally happens is that a startup comes to us with a business plan. I mean, with a basic idea about what is their plan. And once we define terms for the convertible note, for the ratchet, as I explained earlier, they become less confident in their achieving of their goals, because they see, oh, I've said that I'll make 2 million in revenues. What if, So they go back and they come, they go back and tell us, look, maybe it's not going to be 2 million, but it's going to be 1 million. So, and you have to be careful on the other hand, because maybe if you go too low with your plans, you might not be interesting for us anymore, because the whole economics breaks down. So these 6 months, as I said, are also a constant period where we listen to them and listen whether their goals and claims are consistent. Because if you change your mind every time we meet and you promise me that, yeah, I'll sign a major contract next week, and then we meet after 2 weeks and you say, no, that was actually, I have another one now, that's going to be even bigger, This is a normal thing that we see, and this is not good for sure. You have to be consistent in your promises. Was that
another question?
Yeah. Okay.
We'll go back to
Is it possible to disclose the expected IRR for these two funds?
Well, for the second one, of course not, because we've got now less than, I think, around 12% invested, which is way too early. On the first one, let's say that the net asset value of the fund today is just estimated value. It's not, we haven't sold it for that much, but it should be around 25 to 30 million euros. And we invested 16. So that's, I don't know the exact IRR number right now, because it depends on the dynamics of the investments.
Okay, so just quickly to get back, are there metrics that you ask for, or do you prefer to listen to the founders, what they promise and what they deliver?
Well, definitely the second option is better.
Is better.
Yeah.
Okay.
I mean, there are certain metrics that we look at for sure, because
you'd like to know.
Yeah, one thing that maybe it's worth mentioning here is that we are not a Silicon Valley type of investor that would just buy the Facebook likes and the number of users. This is we are at I wouldn't say just a European venture fund, but we are a Central European venture fund, which is maybe even more conservative. And we like to see some revenues, not even if not today, but at some point we like to see that there's going to be some inflows into the company as well.
Do you invest into digital health companies?
Well, it depends what kind of companies. We invested in one company from the we call this MedTech with the first fund, but it's as I said, it's the whole, description of the tech companies today. What does it mean, a digital health? Is this a team of I don't know, software engineers that are developing an app for tracking your health, or is it a device? Is it a hardware? Is it just a software? It depends. I mean, it's a lot of things that can be described as digital health, like the agri-tech companies. The agriculture is extremely interesting at the moment, and we don't claim that we are investing in agriculture, but we say that we invest in agri-tech companies. But as we discussed earlier outside, if you have a digital health company, for us it's very, very important to see that you have this domain knowledge about health and and technology as well, but not just technology, but also health. Because what happens today is that most of the startups can pitch from many different industries that they have no knowledge about. They just know how to pitch. They know the buzzwords, and they know what are the things that we would like to hear, and they are agnostic on the industries.
So since you opened the topic about venture capital funds in the US and venture capital funds in Europe, what are some of the differences, and what do you say would be some of the strengths and weaknesses of, say, Central European startups or Balkan startups seeking investment from a local VC? That's a big long
Yeah,
question.
it's a big topic. Yeah, the major difference is that the venture capital in US has a much longer tradition than in Europe. And I'm not just talking about the fund managers, but also about the investors in those funds. The next big difference is the size of the funds, because some of the funds many of the funds in US are, for my taste, they're simply too big, and that is becoming the main problem for a VC industry as well. Maybe the third thing is that Americans look at European VCs in
Conservative?
yeah, they think that all of us we are way too conservative. That's not even so important. It's US still is one market. It's not so fragmented as Europe. And when you talk to European VCs, especially the ones that are like us, partially financed out of some public money as well, we have some limitations on the investment strategies. We cannot invest, for instance, we cannot invest in a US company that has no substance on the Balkans. And many European VCs have this limitation. So it's not one big market as it is in US. The next big difference is the exit market. I know that there are many theories about this, but honestly, if you want to have a couple of $1 billion exit, you have to go to US.
Yeah.
It's not doable in Europe. Or is it very, very, very limited chance of achieving this? What else? There are for a startup from this region here, you have to know first of all that most of the VCs from US and very, very few apart from very few from UK, they'll not come here and invest. Maybe they'll ask you to move to US, and then you have some chance of raising funds from them. And even if you do so, you need to have a couple of guys that they know very well, local guys in your team. Otherwise, your chances will be very slim. So if somebody from this area has any ambition to raise funds from from the States or from Western Europe, my suggestion would be to start raising here, maybe raise from some local VC fund or angel VC fund. Ask the local VC fund if you can bring some more investors into the syndicate, maybe from Western Europe. Maybe they'll chip in with a smaller amount if they see the lead investor coming from this area, and if they trust the local investor, they maybe will invest even here locally, and then go for the next round on the bigger market.
Speaking of, what are some of the exit strategies for a VC from a startup?
Well,
Or for your investment?
yeah, most of the investments we plan to do trade sales, meaning that we will sell to the strategic buyers.
Okay.
Of course, there's always this option of IPO, but I don't think that many startups from this region will have IPOs on the stock exchange. Maybe it's if we want to set up this. If we want to see more IPOs, I think it's easier to change the rules on the stock exchange, and to educate the investors on the stock exchange, then develop startups to the stage where they become investable on the stock exchange. So, for us, we have basically we are looking to sell our companies to the strategic investors or some financial investors that are investing in later stages.
Would you also sell to a bigger VC fund?
Yeah, these are the financial investors. The problem with financial investors is that if you sell to a strategic investor or strategic partner, they'll look for some synergies between the companies. They'll not just focus on the metrics, on the the returns and EBITDA and some other metrics. And even if the company doesn't create much revenue, it might be interesting for those buyers to acquire this company just because of some piece of technology or maybe users, clients. Whereas when you talk to the financial investors, they'll just purely look at the Excel spreadsheets and the ratios. Yeah.
Okay. So are there questions from the audience?
Hi, you mentioned yourself the business is not a one-man band.
Yeah.
So to use the same analogy, what would be the average number of people in a band that you invest to usually?
2 and more.
2 and more.
Yeah.
What do you mean?
No, we did 2 investments here in Croatia. One was Agrivi, the other one was Balkans. Agrivi had, I think, 8 people when we invested in, and Balkans had around 30. We invested in one company that had 2 people. It was a very small check in Serbia. But yeah, normally I would prefer to see at least 3 to 5.
And just one other question regarding the funds that you are investing also. What would be proportion of that money that you invest that goes into the sales and marketing?
Oh, that's a great question. I'm very happy to hear that, because most of the companies that approach us have business plans just oriented to the cost side of the product, because it's very easy to calculate. It's not easy, but it's much easier to calculate the cost, the projected cost for the product, than it is for the sales, right? And what I really like to see is the plan where they have these reserves for the sales, at least at the level of product or more. Otherwise, I don't think it's realistic. Normally, I think you have experience with that. Otherwise, you wouldn't ask this. But.
So they have to have a customer acquisition cost in the plan?
Yeah, they have to know their numbers.
Sure.
But sometimes it's very hard to know your numbers, right?
Yeah.
especially if you're selling something that's unique, that's new, that has not, it's not proven yet on the market. It's a bit, it's not so bad to have something that it's not so bad to say that we are not sure yet, but in this case, you need to have some reserves for the if-then scenario.
If it's more than you originally anticipated.
It's always much more than you originally anticipated. It takes way longer and it costs
A lot more.
a lot more, yeah.
Any other questions? Okay. Yeah.
How do you decide when a startup has enough traction? Because traction in a market like the US means something different than in a
Sure.
market like this.
Yeah.
So how do you go about it?
Yeah.
Is it thousands of users or hundreds of users?
If you're selling to, if you're doing some enterprise sales, then maybe one user is enough. If you sell to a major brand, to a major label in Europe, that's a traction that we like to see. We don't expect you to have like 20, labels if you're doing enterprise sales. On the other hand, if you're in some not B2C market, because we don't like to invest in B2C companies, but if you're selling to this long tail of small SMEs, then we'd like to see, much higher numbers. I mean, much higher numbers of users. So it's not, again, I don't have the universal answer to this question, but it's very important what kind of companies do you have, and what type of sales have you done. It's I don't know, if you talk to American VCs, all the sales that you've done in Europe are not relevant for them.
Yeah.
Because they think that we are all cousins here, so I mean that's reality. So I remember when we were pitching the American VCs that later on invested in our company called Celtra, and they asked us about the clients, and we just we showed them the list of clients, and they just just crossed all the clients that were from this part of Europe, because they said these are your friends. You could sell to them, and they would just give the money back just to be on this list. It's the same methods in US as on the Balkans. It's not so Balkan specific thing, so distraction is extremely good thing to show to investors. This is because it eliminates most of the risks associated with this product market fit.
So what if a startup, which is a B2B startup, has a very long sales cycle?
Yeah, that's part of the financial planning as well, because normally all the business plans are, how they're done. There's an Excel spreadsheet, and then you've got 1, 2, 5, 20, 50. They have no churn. All the clients that they sell to will stay their clients for the rest of their lives. So they do not count. I mean, not all of them. Some of them are very skilled and very good in that. But I'm just talking about the bad examples. But it's crucial to have this understanding that if you're trying to sell somebody, to put some percentage of probability of this deal to be actually done. Because if you're selling to, I don't know, if you're selling to 10 clients, what's the probability of executing 3 or 4 sales? This is very, very important, because it's all interconnected with the whole economics of the company.
I guess in a B2B startup with a long sales cycle, the question of customer lifetime value is much more important than in B2C startups.
Look, I'll just give you one example. There's a company in Slovenia that produces sailing yachts, and it's a startup, rather successful at this moment. every yacht, every boat that they built is a cost of more than 60,000-70,000 euros for that company. If they sell one boat more per year, they've got like their net is 70,000, because the market price, the selling price is twice the production price. So the whole ratchet is extremely high. If they sell two boats more than planned, they're good. If they sell one less than planned, they're bust. So it's an example of a company with long sales cycles, and you would not know until you're in late December if you're going to make it or not.
Any other questions from the audience? Okay.
Usually 2 questions. When you look at the go-to-market strategy, do you like the founders or companies focusing more on certain regions or certain markets that like they are all at once? And then also, do you look at what's already out there? Certain like larger markets like US, you could already saturated market, so it may not be available here, but it's already could be a leader or company that's already doing business.
Yeah, it's this is one. Again, I'll start with a startup conference where everybody tells you that you have to be globally oriented. If you're a startup, don't be locally oriented. Nobody's going to invest in your company. But if somebody approaches us and says we are a globally oriented company, we'll always ask them, okay, but what's the first market you'll attack? Because you cannot be global from the first day. It's not doable. So even if you're a globally oriented company, you have to have priorities where to go first, right? And then we come to the second, very important thing, specific for companies from this region, that they all plan to start with, let's say, Croatia, then go to the Balkans, then Europe, and then world, which is not. I mean, who says that you need to start here if you want to develop something? If you're developing a mobile app, you cannot start on a 4 million people market, because it's not big enough, and you cannot even test it here. You have to go somewhere where you have an appropriate audience for your product. So it's also very important for us to see, the knowledge and the level of understanding on the founder's side, where he plans to go first and where he plans to spend most of our marketing dollars with his product, because as I said, being located here in Croatia and just planning the global expansion, it's not going to work probably.
Any other questions? No? Okay. So I would like to ask, not going to take any more. Yeah, good talk. I would like to ask about the startups that pitch to you. So you have probably hundreds, if not 1,000 or more startups pitching and sending emails and pitch decks and presentation decks. What is some or a lot of advice that you would like to give them? What are some of the things they shouldn't do, and what are some of the things they should?
Okay, I think we touched this slightly before, yeah, but maybe the first advice would be try to find some referral. Try to find somebody to introduce you to the fund, yeah, because I mean, honestly, we are not a Sequoia fund here. We don't see hundreds of emails on a daily basis coming to our mailboxes. But still, if I just read an email, a cold email, I don't know, who is the guy that's sending this. Maybe I'm just traveling somewhere. Yeah. Maybe I'm traveling somewhere. I don't, I cannot answer at this point, and maybe this email will go in some, trash mailbox. It's always much better to find somebody that that we know, and then go through some introduction to talk to us.
Okay, so what is the role of, say, a junior associate? Or
You have him here. You
One
can
right
ask him
there.
directly. I mean, he collects all the deals, all the leads, and
no, that's one of the things.
fills the pipeline.
Yeah, that's one of the things I heard from the VCs in the US. So you don't actually pitch directly to the managing partner. You pitch to associate, and then the associate, if
Yeah, of course, it's the same here. I mean, you go through some levels of seniority in the team, and you talk to different people at different stages. Even I must say that we are not just waiting for good companies to approach us. We are proactively looking for good companies on the market, which is also very important.
how do you look for them?
Well, we mingle on the events. We have some databases. We ask our people in our network to to be introduced to some companies and so on. So
Okay.
it's a very proactive approach.
Cool. So do you have any final advice for startup founders? In general, not just in contacting you.
No, I'm not. I think in general,
Yeah.
be very realistic about your plans before you pitch the investors, and do your homework. I mean, one thing, it's very often that we hear that we are a bit bureaucratic because we expect business plans, to see business plans, But I don't want to see business plans as as books. I just want them to be made somewhere, so that when I ask you about some specific topic from your business plan, that you have the right answers. That's all.
Okay, cool. Well, thank you for being here today. Thank you for coming.
Thanks
thank
for
you everybody for
inviting me.
Yeah. And thank you all. Have a pleasant evening.